And I'm glad you're here. As always, I've got the mute button on. Most people watch this on the recorded version later, and if you're um, just a little bit about what we do and why we do it the way we do it. So when I show the screen, GoToMeeting won't record both the camera and the screen at the same time. So I have another program in the background recording the camera so that when we put out the link, it actually shows it shows both the camera and the screen because we'll overlay them on top of each other. So I'm going to jump right in and we'll get started. So first of all, for those of you that are listening new, the reason we're here is to try to filter out the noise, gain a little bit of clarity. And when we do that, we can simplify the way we look at the markets and make decisions objectively and focus on what we need to be doing, which is actually getting the crop in the ground. And this is the time of year where you really have to maximize your time. So we hope that this does it for you. I'm going to jump right into the charts here in a second, but I want to make sure that we cover kind of the highlights of what's happening fundamentally, and only from a grains perspective. I know the news is crazy. I know it's all over the place about oil and about the virus and lockdowns, and you can read a lot of things and work yourself up to a tizzy. So as we look at what's happening, we've got the equity markets screaming higher. And when you read the news, it's kind of mystifying. The markets are basically saying, hey, the economy is going to rev right back up. We're not going to have any issues. But then you start reading more articles, and all you see are the number of unemployment claims just growing like crazy. Yesterday, the Wall Street Journal talked about how professionals are now getting hit. Your doctors, your lawyers, your accountants, people who have been working remote from home and are no longer have any work to do. So they're being furloughed and being let go. And then there's a lot of talk about China. And I think this is the hardest thing to get your head around because China's economy has been hurt too. Maybe not to the extent that ours has, because they only shut down one province, right? And when we shut down, we take 350 million people out of the market. When they shut down one province, they only take 75 million people out. And they've got another billion people to deal with. So slowdown in China is hard for us to get our heads around because they have so many people and so many things happening all the time. But if you look at what's happened in China from an import standpoint, the news is talking all about how they've bought all their soybeans from South America. And that's actually not true. They've actually bought a lot of soybeans from us in the first quarter. The news is now out that they've actually bought more than 150% of ag imports over last year's just in the first quarter. And if that pace were to continue, then in the next 18 months, they will have hit their phase one target. So all this talk of China's not performing on phase one, I wouldn't buy into that quite yet, because if you read the news, you're going to find diverging signals. You're going to read people that say, yes, they're doing it. No, they're not. The data is, yes, they are buying from us, and they're also buying from South America. So, and in record amounts. So what they've done is basically gone to South America and front run all of their annual purchase, and they've gotten it all knocked out. And they've still bought $5 billion worth of ag products from us. Now they've got the rest of the year where they should just increase their buying from us here. So it doesn't seem like phase one is dead, and they've got that their food demand is so high, they tend to, they're just doing things on their own cadence, and I don't think we can get too judgy or unpredictable about what's happening. Now, domestically, we are having issues here. Reading lots of articles about food consumption being down 30 to 40% because restaurants are closed. That's changed the way the meat, the cuts we need coming out of the packers. There's a lot of expense in shifting production lines from one form to the other, so they've slowed down capacity. Now we've got the workers coming down with the virus, so they're having to shutter plants. So you've got a lot of uncertainty and a lot of noise in the in the protein market, which is causing some confusion in the grains too. Now, if you look at the cattle charts, I mean, they're crazy. You've had limit moves, I think, literally every day for the last 25 days. Some limit up, some limit down. And the grains have really been pretty pretty smooth when compared to equities and everything else. Now, we talked last week about prevent plant, and watch the forecast, because if it's wet at these price levels, farmers are incentivized to take prevent plant. They are not incentivized to plant it if they're in a situation, especially in the I states, where they need to, if they've got the chance to take it, they should take it, unless we get a rally. We talked last week, December corn's got to put a little bit more premium on to fix that equation if it gets to a situation where it looks like too many acres are going to go. So there's a lot of lots of things uncertain, lots of questions. Let's look at what the market is telling us to do on the charts. All right, we're going to start with soybeans today. Then we're going to go to wheat. Then we're going to go to corn, and we're going to spend most of our time in corn. With beans, let's try to back up and put this into perspective, because you can read this chart as this is a continuation of the downtrend or the beginning of something new. And both readings are equally valid, and we don't have a good bias to figure out which one is right. And that's exactly what this is telling us. So on the one hand, if you start with this peak here and you move all the way down to the recent lows, and you read all of this in total, what we have is a big downtrend with an exhaustion spike that ignited this little rally. Now, this rally can either be a counter trend pullback in the context of this larger trend, or it can be the beginning of something new. So what is an uptrend? It's higher highs and higher lows, and a downtrend is lower highs and lower lows. So the question is what is this little pullback right here, right? So we rallied off the low, now we've come back down, and we have this hook reversal here. Now, this is in context of a big, strong up move, which is characterized both by price action and these lower oscillators moving higher. So is this a counter trend pullback, or is this the beginning of a new leg down? This right here is going to be our guide. So with this hook reversal and this hook reversal that happened on Monday, soybeans put themselves in a range, and a move below this 84 level or 54 level tells us that likely these new lows are going to be met and or exceeded. So we have stops in. So what we did here is recognize that this could be a big up move. So we entered a long position here and bought puts, because we didn't know which of these readings would be right, and we still don't. So what we've got is a stop in right below here, and we may get it triggered here before the market even opens or before the night session closes, which is fine, because that should accelerate on down to the downside. And if it does, we're looking for this move here to conclude with a big triple divergence, which would signal that a long-term low has been put in place. Now, corn is, I think, what is gonna guide us here. So before I get there, though, let me go to wheat. Wheat's had an interesting run up here the last few days, and it's very similar to soybeans. So we've had this big move to the upside with strong volume and strong momentum, which tells us that likely this was a counter trend pullback, which we bought, and we got stopped out of that position overnight right at the open. We got stopped out right in here. And the reality is This is still just a counter trend pullback unless this low here is taken out. So below 467 in July wheat, we are bearish wheat and think that we could head significantly lower. But until that gets taken out, the odds favor that this be removed. And the reason for that is the strength of this move coming off of this low. This was very strong volume. And anytime you've got a big move coupled with strong volume, the likelihood of it being uh, met or exceeded is pretty high. This could be it. I don't want to take anything away from the fact that Monday morning we had this high and we've traded straight down since. But it wasn't, if it had taken this high out, it would be a lot more persuasive to call that a hook reversal, or if it had closed below this high here. So I think the market's reacting to it as if it was, but I'm not sure that's really what the reading is. So right now, the best position is to look for this to be a buying opportunity in wheat with another push to the upside. If this low falls, I think that's kind of like a line in the sand. Likely it would accelerate to the downside. So we'll see what wheat does. And I guess the only other thing from a support and resistance standpoint is this area here is seeming to be a little bit of support again this morning. We'll see if it handles it, or if it breaks back below it, which could accelerate it to the downside too. So both wheat and beans are triggering kind of a short-term trading range, trying to decide whether they need to, which direction they should start a new leg. And that's not being indecisive. It's just price discovery, and a trend will manifest itself probably sooner rather than later. We just want to make sure that we are prepared for whichever direction it goes. All right, now let's go around the corn world here. We talked last week about how corn was meeting every trend exhaustion signal that we have that we follow, and that's absolutely still true today. And these are trend exhaustion signals that started a year ago at the peak of last summer, all the way back here at this zero. These signals here are completing this move. So what we have is a big move to the downside. We have this big divergence where, as the move has accelerated, volume and momentum have declined. So we have lower prices with less enthusiasm or less panic coming from the markets. Oh, and we just got stopped out of those beans. So looks like the market wants to work lower on beans, and let's go back to those and take a look. So we just took out those stops, and we'll see what happens. That's right below this low, and that should accelerate and move onto the downside. But we won't know that for several more hours until something more manifests itself. So that's the beauty of having auto trades, is that they just do it for you. All right, so back to corn here. With this divergence in place and this 13 in place, all of these are telling us that this move to the downside is losing its momentum. Now, that reading holds above this 319 level in July. If that level falls, then we could extend this leg we could extend this leg down a little bit lower and trigger another 13, which would just reinforce everything else about this move. So chasing this to the short side here is a very risky proposition, because as these things continue to diverge, they will run out of sellers at some point in time, and we have a long way to go before the crop is made. So we're not big corn bulls here, but we're not bears either, because this thing should come to an end at some point. So that's the May contract. Let's look at July. July is doing the exact same thing, diverging on each of the lower indicators with a 13 and a completed 5-wave down count from the summer high. This wave 5 started all the way back here in November as we were tracing that big wedge to the downside. So yes, it can extend. Yes, it can work a little bit lower. No, it's not something that should be traded aggressively to the short side, because everything here is telling us that that move is closer to an end than it is a beginning. December. December is a big one because just yesterday it triggered its 13. And again, it's coming off of that same move from the upside. So you've got the same set of signals in December, July, May, and September has it here too. I'm not going to show you that because what I want to do is come back to May and show you the weekly chart, because here you have a signal, the same set of signals on the weekly charts. You've got divergences on your lower oscillators. You've got a 13, which started on this move from a year ago at the summertime. So the best time to sell this market would be after a rally. These are warning signs that the move to the downside is showing exhaustion and likely will trade sideways to a little bit higher until more is known. Now, if we look at the seasonality of these markets as well, they support that thesis too. So seasonally, between now and mid-May, we would typically see a little bit of upward movement before the summer, June, July time period happens, when we peak, and then we work lower into harvest. Now, this makes a lot of sense fundamentally if you look at, okay, we're going to lose 500 million bushels of corn demand to ethanol. Maybe China's not going to buy. Maybe our domestic feed demand is down. Maybe maybe we're going to grow an 18 billion bushel corn crop. Maybe our carryout's going to swell to 5 billion bushels. Well, before you can do that, you have to have the bushels first. So you have to make sure they're planted, and you have to make sure that they're going to be harvested. So logically, that makes an awful lot of sense that this shouldn't quite be run. Now, if we keep getting bearish headlines about ethanol and all of the plants shut down, then you could see speculators rush in and push this thing lower and accelerate it to the downside. But that just doesn't seem to be the best reading today. Now, if we go all the way back to 2016, I'm going to give you a little broader perspective here on corn. This goes all the way back. This is 2014. So here's the low here. You can see how these wave counts complete, right? So the low in 14 came out at 318. The low in 16 was 301. Then you've got each of these lows right in here. We don't have a whole lot of support until we get down into this level right here. So this 315 to 320 level is very important to hold on the May contract. If those fall, then I think the market's just going to kind of collapse and work on lower to the downside. So anybody's guess, but I think there's a lot to happen in the corn market, and the upside seems less risky than the downside today, at least until we get the crop planted. All right, I'm going to go back because I forgot to do this last week. We've been tracking the spec programs that we enter, and if you had invested $10,000 on February 1st, it is worth $13,400. Last week, the only trade we entered was soybean futures, and we also put on a put. So those futures are now closed. We got stopped out of wheat last night as well. So long puts in wheat, long puts in beans. We're spread in corn off of the most recent lows. I'll have to look to see where the stop is on those. We may be coming out of that position too. But the program will be looking to re-enter as we talked, as wheat turns off of these, back off of this low. It'll be looking to buy strength into here and to sell weakness down below that line. Same with beans. Beans is going to be looking to to sell weakness below here, and we'll be back long, back above this 862 mark very quickly. So it'll sit there and just set the spread and try to capture the movement either direction it goes. Again, it's not trying to pick highs. It's not trying to pick lows. It's just trying to capture the big movement after a consolidation period, which is right where we are. So stay tuned to that. That is 20 minutes on the dot, and we'll call it a day. Thank you for joining. If you have questions, please call, and we will talk to you next week.